Hello and welcome to the Short View. I'm John Authors. We're in the middle of a quite remarkable run on the shares in Fannie Mae and Freddie Mac, the two giant US mortgage agencies, which looks scarily reminiscent of the run on Bear Stearns back in March. This is what's happened to Fannie Mae's share price over the last 12 months, down almost 80%. And now we'll show you what's happened to Freddie Mac, the smaller of the two agencies, and you can see they've been down even more. In the last couple of days, that's become acute. At one point, they were down 30% for today alone. Now, if we go on to show you valuation, you'll see how extreme the situation is. What we're showing you here is the dividend yield on US and European banks going back to 1990. And you can see that the sector as a whole is trading at extreme levels, which imply virtual certainty that dividends will be cut as part of their attempt to raise capital, and also plainly implies some risk that some banks will go under. Now let's show you the dividend yield for Freddie Mac, and you can see that it reached the quite incredible level today of 13%. Now what's remarkable about this is that Freddie Mac, like Fannie Mae, is a true linchpin of the US mortgage finance system. It's truly too big to fail. It cannot possibly be allowed to collapse. So, how can this have happened? I think that what we see at the moment is a vicious circle. The market knows that that the agencies need to raise equity finance to bolster their capital. That puts pressure on the share price. Once the share price gets lower, it becomes all the harder and more expensive for them to raise capital, and that pushes the share price further. I don't know how they will get out of this vicious cycle, and it's intriguing that despite the remarkable conditions for these two very important companies, the stock market as a whole is up. But the critical question for the market at this point is how Fannie and Freddie get out of this vicious cycle.